Let's take a look at the markets. Asian markets were mostly down ahead of a federal holiday in the United States. Concerns continue around whether the aggressive onslaught by some central banks against inflation might result in slower global economic growth. The Nikkei share average in Japan declined by 0.74%. Hong Kong stocks bucked the trend, with the Hang Seng Index ending up 0.42% in the green. Mainland China is still struggling to bring the coronavirus outbreaks under control, and there are worries around how this will impact the country's growth story. The Shanghai Composite Index closed down by 0.04%. In the United States, U.S. markets ended the week generally higher after a generally tough week for stocks. The Dow Jones Industrial Average ended down 0.13%. The S&P 500 rose by 0.22%, while the tech-heavy Nasdaq ended up 1.43%. Let's take a look at the indicators. All right, let's catch up with Gary Boyson. He's a portfolio manager at Rand Swiss to break down the markets for us. A very good afternoon, Gary. Markets have really been all over the place. Today, we see a little bit of a general pickup in European markets. Asian markets were mixed, of course. Just tell us about the fact that the U.S. market is now in a bear market. What is that concept? What does it mean? And do you think that there's more downside for weakness, given that that is really the leading market? Market.
Yeah, well, thanks. It's nice to see a little bit of green on our screens today, with the all-share index up almost 1.5% at the moment. So that's at least a little bit of optimism. But as you say, the U.S. markets are closed, so it might not last too much longer. Now, the whole concept, I suppose, of a bear market is traditionally defined, if you want to look at the formal definition, as a fall in any market of about 20%, or at least of 20% from previous highs. So at the moment, if you look at it, just the year-to-date figures for the U.S. markets, for example, you've got the S&P 500 down around 23% year-to-date. So that's not even from the highs. I mean, the highs were around the beginning of the year, but I mean, we threw the 20% there. The Nasdaq is down around 31% for the year, so putting that firmly in bear market territory. Surprisingly, the JSE year-to-date is only down, if you look at the all-share index, is only down 9.3. If you're tracking the top 40, that's down around 10%. But South Africa doing, I think, surprisingly well, just given what's happened to commodity prices, and a lot of our commodity stocks having been able to buck the trend, and that helping to lift the actual index level. So South Africa not in a bear market, but what does a bear market mean? Of course, it means anyone invested in equity markets is having a very difficult time this year. Bear market is also characterized just by I think a lot of fear in the market at the moment, and I mean we can measure that with various kind of formal metrics. One of them is an index called the VIX, the volatility index. It gives us a sense of how people are feeling. You can also look at put-call ratios, all sorts of things. But yeah, there's certainly a lot of fear out there in the market, and that's because of this big drawdown in equity prices. It's been pretty indiscriminate. I mean, it's been across asset classes. You've seen falls in the bond market as well. Alternative asset classes like Bitcoin have also been hammered. So it's been a very difficult year for investors. And unfortunately, stock markets often are a leading indicator of economic performance. So what the market is telling us, certainly internationally, is that there are tough economic times to come.
Yeah, of course, as South Africans, we don't like commodities to come down in price because we benefit generally, but we don't mind the oil price coming down in price. That seems to have lost some steam. What's driving that, and is it a sustainable reason as to why that price is coming down?
So there's been a lot of disruption in the oil markets, and absolutely, we would love it if the oil price was a lot lower, because the high oil price has been one of the major factors stoking this global inflation concerns. And I think anyone that's been to the shops recently has felt the impact of that oil price in food prices specifically. But the oil price, yes, unfortunately, I think it's coming down for the wrong reasons, which is really, it seems to be more macro drivers than the fundamental supply and demand dynamics. And I think it's an expectation that we're going to see slower growth internationally. There's a real fear that we're going to go into a US recession. We're going to potentially see a global recession. And that's, with lower growth expectations, that you would expect demand for oil to cool. And that's why you got the demand side of the equation playing into it a little bit. I had a look at the rig counts as well. The rig counts are actually up slightly. So, but it's ever so slightly. The last print it was 7 more rigs in the count, which, will add a little bit of supply into the market, but not enough to cause the sort of almost $10 a barrel oil drop that we've seen, in the short term. So I think mainly it's the rate hikes playing in, mainly the recession fears. But I mean, the oil market is very, very difficult to read at the moment because at the same time, you've also got a release of the U.S. Strategic Petroleum Reserves. If they continue releasing reserves as they are at the moment, by the time we get to October, their Strategic Petroleum Reserve is going to be at 40-year lows. So, you're certainly seeing the U.S. trying to stabilize the oil markets. At the same time, you look at what's happening between China and Russia, and you're actually seeing imports of Russian oil into China are up 55% from this time last year. So there's been a lot of disruption just with the Ukraine war, with, I suppose, just what's going on, just with supply chains, with COVID, with everything. So a lot of changes in the oil market at the moment, and the kind of volatility that we're seeing in the oil price is probably not unexpected.
Once upon a time, and it's actually not that long ago, Bitcoin, you could fetch Bitcoin for $65,000 US. It dipped below $20,000 US. It's a very, very hairy environment to be invested in. But what does it tell us about how investors feel about being invested in Bitcoin when there's a general lack of sentiment in markets generally?
Well, I suppose one of the big arguments behind Bitcoin is that it was going to be a true alternative asset class that was going to give you a non-correlated hedge. So it was going to do something else when the rest of the market was falling. Unfortunately, that hasn't been the case. And as stocks have fallen, as bonds have fallen, cryptocurrencies have fallen as well. So it hasn't really provided that kind of little safe haven aspect that a lot of people, I think, were hoping for. As the price collapses, when a price collapses in any market, and specifically a trading and speculative market like Bitcoin, you tend to see big institutions almost getting into trouble as they have drawdowns from their portfolios, as potentially if they were using leverage, they can't reach margin calls. This exacerbates the problem. Lending dries up in the market as well, which means less leverage trading, which means less volume. And I think all of that is playing out in Bitcoin at the moment. I mean, it was always a very, very speculative asset class, and I think anyone that had looked at it properly, had gone in hopefully with the right risk appetite and should be able to ride through these kinds of swings, because you definitely shouldn't have been investing in Bitcoin if you thought, you shouldn't have been betting the farm on Bitcoin if you want to put it that way.
Yeah,
but yeah. You take Bitcoin for what it is, a very, very speculative asset class. And yeah, there's a lot of volatility in asset classes like that. Is this the end of Bitcoin? I still don't think so. I think the amount of the technology behind it and the amount of work that has gone into crypto markets and crypto exchanges, I don't think we're going to see the end of it. But certainly I think investors need to batten down the hatches. I think there's probably more volatility to come.
And then, Gary, just in terms of company news, it does seem to be rather quiet, but I understand that you looked at Storage, a company called Storage. Tell us about their results.
The Storage is it's quite a recognizable brand in the self-storage space, certainly around the major hubs in South Africa. Interesting little business, not particularly large company listed on the JSE, but doing very, very well. It's essentially these self-contained storage units, and throughout the COVID pandemic, what's happened is just, again, with the shift, it has benefited from people shifting out of offices, moving to hybrid space, people potentially having to move homes and put things into storage. So their results looked very, very good today. I mean, if you look at their rental income, up around 15%. Doing pretty well through the pandemic, and really, I suppose, one of the few companies that has benefited from the chaos that we've seen in the economy over the last 2 years. So a nice report from the company now, also buying some UK assets and a very, very solid update and a nice 53-cent dividend that they'll be paying to shareholders.
Super. And then, of course, in March 2020, we saw markets really hit a terrible bottom, and some investors got stung because they decided to sell off because they were concerned, only for the markets to leap back some 4 to 6 months later. Do you think this is what we're going to see with markets generally? What's your advice to people? Should they just stay invested, or should they run where they can?
Well, I think running now may be a little bit too late. So there's a wonderful little study that was done. After 115 trading days, how much is the market down currently? And this is probably one of the third or fourth worst periods ever for 115 trading days. But then they looked at the next year, and overwhelmingly, the majority of the time, in the next 360 days, the market does actually end higher than it is now. So I think diving out of the market after you've seen such aggressive falls as we have, like I said, NASDAQ down almost 31%. It's definitely not to say that there couldn't be more pain to come, and it could still be volatile for a significant period of time. But I think the best advice in markets like this is you keep calm and carry on. If you've got the right strategy, if you're working with a financial advisor, if you've invested in assets that are correctly aligned to your risk appetite, you really shouldn't be panicking in a market like this. This is really an opportunity to deploy more capital if it's available. If you can potentially cut back on those discretionary expenses and put it towards your investment portfolio. You look out, say, 1, 2, 3, 4, 5 years, and I think you'll be very, very happy you did it, because there's no question that there are some amazing assets on sale at the moment.
And lastly, Gary, what are the key economic or market driving factors that you're going to be looking out for this week?
I think the big one, there's a lot of Fed officials that will be speaking this week, and obviously we had the 75 basis point rate hike last week from the US. I think that's really what's just got everyone so rattled in financial markets. So I think getting a little bit more clarity around what the Fed is thinking and how the Fed is approaching these markets. Already we've had some Fed officials come out and say they will do anything to kill inflation at the moment, and I think it's how the Fed speaks to the market this week is going to be absolutely key to seeing if we're going to finish the week higher or whether we're going to be finishing with another red week.
All right, so we'll wait and see. Thank you very much, Gary, as always, for your time and insights. Gary Boyson, he's a portfolio manager at Rand Swiss.